Hello, everyone. Welcome to today's webinar. My name is Joe Torre. I'm one of the investment counselors here at RealWealth. And today we're going to be talking about real estate math, how to crunch the numbers so you can make better investment decisions. And happy Bastille Day for those of you who are following things like that. First, a couple of housekeeping items. Okay, this is our standard disclaimer. The strategies mentioned in the presentation today may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, or attorneys to discuss your specific situation. And as always, past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. And while every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. So this is mostly oriented to our property showcases, but as it relates to real estate math, if you follow the steps today and then make a math error somewhere, that's on you. So let's move on. All right, just a little bit about me, so I'm not just some talking head here. I've been a RealWealth investment counselor since 2016. I've been investing in real estate since 2004. Back then I was buying in Phoenix. And that's always a good sign. Everybody looks like a genius when the markets are going up, but to survive 2008 and have your portfolio survive 2008, that's always a good sign. I currently have a portfolio in single family homes in both Alabama and Florida. Before RealWealth, I was a marketing analyst for tech companies in Silicon Valley, Cisco Systems, Symantec, those kind of companies. And my background's an MBA in finance and economics. All right, so this is the agenda for today. We're going to go over questions that we get a lot. We hear a lot here at RealWealth. So here's four. One, should I use extra cash to pay off a mortgage or buy another property? We hear that quite often when someone has extra cash. Secondly, should I take out a HELOC to buy an investment property? Get that often. The third one, we've gotten a lot in the last year, specifically in Florida, where people put a earnest money deposit down on a property, but because of materials costs, just before closing or getting close to completion, the price of the house goes up by 40K. So when that happens, does the deal still make sense? So you need to be able to figure that out. This is happening a lot less, by the way. I think the worst is over because the supply chains have caught up, but it still can happen. And then finally, should I raise rents as much as possible, but risk losing the tenant, or raise rents not so much? That's always a conundrum that we have whenever leases come up for renewal. So what prompted this webinar topic was that I get a lot of questions from investors all the time, questions like these. And it seems to me that as an investor, it's a core competency for you to be able to do a little back of the envelope math and figure out for yourself what your best move is. So the investment counselors are always here to help you with that, but you should be able to take a first pass at it at least, so you can see understand what your options are and then how to evaluate what your best move is. And also, it gives you more confidence. If you're doing something because you understand the numbers and you understand why the decision you made is the right one for you, that gives you more confidence, as opposed to just doing something because this is what your investment counselor recommended. I'm kind of doing a balancing act in this webinar because on the one hand, I want to provide information that's useful and actionable. On the other hand, I don't want to have a bunch of eye charts of spreadsheets and numbers and make everybody fall asleep. So I tried to make the presentation as simple as possible while still getting the key points across. The desired end state, the goal for this is that by the end of this webinar, about 1 hour from now, everyone attending should be able to look at these 4 questions and be able to take a pass at figuring out what their move is if they come across these situations. All right, let's start with the first one. All right, here's a question. Should I pay off my mortgage or buy another property? So here's the scenario. An investor has some extra cash. She can pay off the loan on one of her properties and own it free and clear, or use that cash to buy another property. Now, normally that would be a fairly straightforward question to answer, but just to make it interesting, this particular investor is 65 and risk averse about taking on more debt. And also she believes we're going into recession pretty soon. So that throws another dimension into the question. A lot of people have this hangover from 2008 when people were underwater on their mortgages and couldn't make payments and lost a lot of properties. In fact, I have a personal friend who had 14 properties. They were all bought under liar loans and leveraged to the max, and he lost all 14 in 2008. So this is a real concern. So how do we answer this question? How do we try to solve this problem? So first we look at the numbers. Here's the property that she owns. She bought it for 150, put 20% down. So her loan amount was 120 at 4% interest, and her loan balance is 100,000. She has 100,000 left on the loan, and her mortgage payment is 570 a month. So what would happen if she paid off this loan? If she paid it off, she'd be out 100,000 obviously, but her cash flow monthly would go up by 570 because she doesn't have to make these payments anymore. That comes to 6840 a year. So the 6840 a year divided by the 100,000 she put down, it's effectively a 6.8% return on her $100,000, which is pretty good. And note also, there's no risk. When you pay off a loan like this, the savings are guaranteed. So that's money in the bank. So now let's consider what other options she has for using that 100,000. Okay, so with the 100,000, she could also use the money to buy a Dallas duplex. Purchase price of 370, down payment, and closing costs. That gives you the 100,000 investment that she would need to buy this duplex. And when you factor in the rent and all the expenses, the monthly cash flow comes to 625 a month, which is actually better than what she would save over here with the 570, and an annual return of 7,500 a month, and a return on investment of 7.5%. So on paper, it looks like this is a better return on her 100,000. Not only that, she's picking up an additional asset. And if you believe that Dallas real estate is going to appreciate about 5% a year, which is pretty conservative, she stands to make about 80,000 in equity growth over the next 5 years as a kicker in addition to the cash flow. So at first glance, it looks like the Dallas duplex is a better investment than the paying off the loan. But let's look at some non-financial considerations as well. So the numbers indicate, if you look at the numbers alone, that she'd be better off buying the other property. The other thing is she has a low interest rate. If you notice, that loan was at 4%, and that's cheap money. Why would you want to pay off that loan? Interest rates are going up, soon to be 6%. So if you have 4% money working for you, why would you want to pay that off? So normally this would be kind of a no-brainer. You'd buy the Dallas duplex. However, remember, she's risk averse. She is afraid of a recession coming. She's she's 65, and so she's not really interested in taking on more debt. It makes her nervous. So if this kind of investment, even though it makes sense financially, if this is going to keep her up at night, or if this is going to make her lose sleep, then it's not worth it, you know. So the numbers can say one thing, but at the end of the day, you have to be comfortable with whatever decision you make. So there are non-financial considerations that you have to incorporate also. So she might consider some other options. One option is don't do either. Don't pay off the loan and don't buy the Dallas property. If she did that, she would have a nice financial cushion of 100K, so that if we do go into recession, or if there is a problem in the economy, that she's protected. She's got enough cash to see her through it. That's what got people in trouble in 2008. It wasn't that housing prices went down, because housing prices can go up or down in the short term. In the long term, they go up, but in the short term, they can do anything. The problem was the borrowers had no liquidity, so they didn't have enough cash on hand to carry them through the rough period. So if she keeps 100K in a money market fund, then she has a financial cushion, so she can sleep at night a lot easier. On the other hand, that's kind of a lot of money to just have sitting there. So another option that's in between, instead of buying the duplex, she could put 50,000 down on a house in Dallas, buy a house and get some cash flow coming in, pick up another asset, have some appreciation potential, and still have 50,000 sitting on the side in case of an emergency. So as you can see, this is kind of a good case study because it shows that the numbers tell you one thing, but that's only part of the story. You also have to incorporate other qualitative issues and then make up your mind about what's right for you. If it were me, I would buy the Dallas duplex, but your mileage may vary. It depends on what your situation is or this investor's situation. There's no one right answer. The numbers are good for helping you guide your decision, but they shouldn't make the decision for you. At the end of the day, you still have to do what's best for you. All right, let's try another one. All right, here's a common question. Should I take out a HELOC to buy an investment property? So a HELOC is a home equity line of credit. It's basically a loan using the equity in your home as collateral. So in this scenario, the investor has cash set aside for reserves in case of an emergency. He wants to buy another property, but doesn't want to use his reserves, which is smart. But he has 200,000 of equity sitting in his primary residence that's just sitting there, and he wants to know if he should tap into it. He can get a $60,000 HELOC and then buy a property in Florida. So again, let's start with the numbers. What did the numbers tell us? So here's the house that he's thinking of buying. It's a Jacksonville, Florida, single family home, 219,000. The down payment and the closing costs come to 59,375. That's the 60,000 he wants to borrow. The rent is 1,550, and after expenses, he's making only $86 a month. So it's basically breaking even, and $1,000 a month in annual return. His ROI is 1.7%. So this is obviously, he's not buying this for the cash flow because $86 isn't that much, but the 5-year appreciation, if the property appreciates 5% a year for 5 years, he stands to make 48,000 in equity growth over the next 5 years, and that's pretty attractive. The $86 is nice, but it just basically pays the bills while your property is appreciating. Okay, so let's see what else, what a HELOC does. If he doesn't have the money for the down payment, he has to borrow that against equity in the house. That adds a new line item to the P&L. So now he has a HELOC at 4.5%, and that's adding $206 to the monthly payments. Basically, he's 100% financed at this point. He's borrowing the down payment of 25% of the purchase price, and he's financing the other 75% with a conventional loan. So now you notice that he's done that. The cash flow is now negative. It's minus $121 a month, minus $1,448 a year. So does this mean he shouldn't do it? Well, not necessarily. $121 is not a whole lot of money to be negative. And I did the math. If rents increase 3% a year over time, the property will break even after the second year. So what we're really talking about is having a little bit of negative cash flow for about 2 years until rents catch up and make it break even and then go positive. So let's consider some considerations. With 100% financing, this property has negative cash flow, and that introduces some risk. So that's one thing to consider. The other thing is the primary lender, the conventional mortgage for 75% of the loan amount, they may not allow the down payment to be borrowed. When you fill out a loan application, they ask you, is any part of the down payment borrowed? Sometimes with a young couple starting out, their parents will help them buy a house by putting the down payment for them. And that makes banks nervous because the bank wants the borrower to have some skin in the game. So if everything is borrowed, it's 100% financed, that makes them a little nervous. So you have to check with your lender, or this investor would have to check with his lender to make sure that's even possible. If not, he has to find another lender that will allow it. But that aside, let's say you can resolve that. Questions to consider: can the risk be offset with other cash flowing assets? So let's say this investor has 5 properties and they're bringing in $2,000 a month in positive cash flow. Well, those other 5 properties with the positive 2,000 could easily cover the minus cash flow of $121 a month or less for the next couple of years. So overall, this portfolio is still cash flow positive. So he's in good shape. So just because this particular investment is negative doesn't mean you should walk away from the deal. The other thing is the equity growth of 48,000 that we saw on the previous slide is pretty substantial, and that kind of dwarfs the negative cash flow for a couple of years. So all said, other things being equal, this looks like a sensible move to take money out of his HELOC, to borrow against the HELOC and put the money to buy another asset that's cash flowing, will be cash flowing in a few years, and will appreciate likely. One final note on this, the example I had here was a Florida property that barely broke even with down payment. In other markets, the high cash flow markets, you could still have positive cash flow with a HELOC. So here's an example of Birmingham, Alabama, which is one of our better cash flowing markets. You can see the purchase price is only 148, but even with the HELOC of 140 a month, the property still has positive cash flow of 116 a month and 1397 a year. And the appreciation is a lot less because Alabama is not an appreciation market, but it's still substantial. And so just because the numbers were negative in this particular example, it doesn't mean that you should ignore HELOCs or not consider HELOCs. In other markets, the results could be a lot better. All right, let's go to the third one. Now, the first two we looked at were kind of warmed up with relatively straightforward scenarios. This one is going to be a deep dive. It's a scenario that we've seen all too often in the last year. So the investor put his earnest money deposit down on a home in Tampa 1 year ago. And due to material shortages, lumber, garage door appliances, everything else, the home price went up. So the investor's house that he or she originally put in under contract at $350 is now $390. So now the investor has the choice, do I move forward at the new price and pay the extra 40K, or should I cancel the contract and get the earnest money deposit back? So how do we look at that? We go back to the original pro forma. This is what you do when something changes. You look at the original pro forma, the one that helped you decide to invest in this property in the first place. So the purchase price was $350, all in for $95K, given the rent and the expenses, has great cash flow, $482 a month, and return on investment 6.1%. Plus Tampa real estate appreciates, so if it appreciates at 5% a year, this investment has a chance of giving you equity growth of $75,000 over the next 5 years. So that was a pretty compelling investment, and you can see why the investor did it. But now that something's changed, how do you account for that? So simply, you make an adjustment. You take out your original pro forma and you do a little back of the envelope calculation here. So what changed? The purchase price went up by $40,000 and the down payment with 25% went up by $10,000. So you take the original pro forma and just revise some numbers to reflect what's changed. So the price is higher, the down payment is higher. Note that the mortgage payment is really higher. Before it was $1,360 a month, now it's $1,700 a month. That's gone up quite a bit. And the reasons are twofold. One, the purchase price went up, so there's more to finance. But secondly, in the last year, interest rates have gone up. So the combination of those two factors makes the the mortgage payment go up a lot. And that really impacted the cash flow. Taxes went up a little bit because you're paying property taxes on the percent of the purchase price. But the main drawback here was the increase in the mortgage payment. So you can see the monthly cash flow is only $117 a month, where it was $482 before, and the return on investment is only 1.3%. So, the 5-year appreciation is about $85K, which is still good, great. So what considerations should the investor take into account here? So first of all, you waited a year to get the house built. So it'd be really a shame to cancel a contract at this point and get your earnest money deposit back. You can get the money back, but that money was sitting there the whole year. It's dead money. You're not getting any return on that. And secondly, you notice that the cash flow is positive even after the price increased. And you still have the potential to make that 85K, let's go back, 85K in appreciation. This 117, that's okay. That's not a life-changing number, but the 85K, that could be a life-changing number. And that's what we're looking for, something that'll really move the needle, make a difference. Another consideration is that rising rents might help offset the price increase. So going back here, the rents were $2,600 back then, and we still have them at 26. What if the rents have gone up? So you talk to your property manager, say, what is this property going for now? What's the going rate? What do you think you can rent this for? She might come back and say 2,800. And if so, then you do a sanity check. Go on Zillow.com or Realtor.com, any of those sites, type in the zip code of the property and look for something similar. Same square footage, same number of bedrooms, same number of baths, brand new, and see what the going rate is. Are they really renting for 2,800? Is that number reasonable? If it is, then you plug that into your spreadsheet and account for that change as well. If not, then you ask the property manager, why are you being so aggressive? Do you know something I don't? Maybe the property's on a great location or something, but the comps online, at least, are not suggesting that the 2,800 number is justified. So whatever you find out from your research, you plug that number in here, and the rents might offset the price increase. Another thing to consider is if you do terminate the contract, what are you going to do with your money? You're going to have to invest in something else, and whatever that is, that has probably gone up in the last year too. So you know, if whatever you're buying, if you're buying something that's 300,000, well, last year it was 250. So you may as well continue with this contract because you got time and an investment in it. And finally, the long view. I mean, real estate is a long-term investment. You know, you have to think long-term. 10 to 20 years from now, when that house is worth, 550 or 600,000, you're not going to remember that it went up by 40,000 way back in 2022. It's going to seem unimportant. So in this scenario, I would say this investor should go forward with the investment. You're already in for a year, and move forward, get the slightly positive cash flow, but mostly the appreciation upside. All right. I wanted to say a thing about ARMs, adjustable rate mortgages. Some of our property teams, like in Florida, are now recommending ARMs for investors. And some investors, as soon as they hear ARMs, they shut down. They don't want anything to do with it, because back in 2008, a lot of people got into trouble with adjustable rate mortgages. They have what they call teaser rates. So you get in, and the first 3 years, the mortgage payments are really low, and then suddenly in year 4, the mortgage rates goes up, and then these people couldn't make the mortgage payments, and they had to lose the house. So there's a lot of bad reputation around ARMs, but that's not really the best way to think about it. To just disqualify them off the top without even considering it is not wise. So the thing to do is to run the numbers and see if you do have some exposure. So we'll just go through an example here. So here's a new scenario. Here's a 300K property, 25% down, so the loan amount is 225, and this investor's considering a 5-1 ARM. So what that means is that the mortgage payments are fixed for the first 5 years, and then starting in year 6, they can adjust if interest rates have gone up, or if interest rates have gone down, they can even adjust down. But that's not the scenario you're worried about. It can go up only once a year and a maximum of 2% each time. So this is called a 225 loan. So it can go up 2% in year 6, it can go up 2% in year 7, and only 1% in year 8 for max a lifetime cap of 5%, 5 percentage points. So that's why it's called a 225 loan. So for this, I have to thank Shaylee Ridge, our boutique lender at Ridge and Lending Group. She does ARMs all the time and all kinds of unusual kinds of loans. So she helped me put together the numbers for this presentation. So let's look. The way to look at it is to look at the numbers and see what your exposure really is. Are you painting yourself into a corner 6 or 7 years from now by taking on one of these loans? So the way you do it, this looks like an art chart, but it's not bad. What you do is you take your pro forma for that first year that you got from the property provider, and in this example, it's a 2,600 rent. You have your expenses and cash flow and return. So Shaylee gave me these numbers based on this 51225 owned ARM. It starts out with a 7% interest-only loan for the first 5 years. So therefore, the monthly payments for the first 5 years are really low, $13.10. And you can see the cash flow is great, $500 a month going up to $800 a month. That's really good cash flow for a brand new property. Some people balk at the idea of an interest-only loan, but really, if you had a conventional 30-year fixed loan, how much of your payments the first 5 years go to principal? It's hardly any. 99% of it is going to go to interest only anyway. So you're not really losing much in the first 5 years by doing that. Now here's where it gets interesting. What happens in year 6? So you plug in the worst case scenario. If it goes up by the maximum amount of 2 percentage points from 7% to 9%, your mortgage payment jumps from $13.10 to $18.86. That's a huge jump. And your cash flow drops by about $500 down to $312. But still, you have positive cash flow and it's very healthy. So you're good so far. So what happens in the next year? Assume again the worst case scenario. Don't assume the best case. Assume the worst case. What's the worst that can happen with this loan? And in that case, it goes up to $22.03. So now the cash flow goes down to break even, basically $78 a month, which is basically nothing. It's just breaking even. And then finally, in year 8, you've already gone up 4%, so you have 1% left on the 5% lifetime cap. If the worst case happens, it'll go up a little more to $23.68, and your cash flow goes down to to 1. So remember, the rents have been going up 3% a year, so it's pretty healthy growth, but you're down to basically break even by year 8. Now, as the rents keep going up, your cash flow will recover 87 and then 178 and so forth. So when you look at it this way, you can see that if you do take on this loan, even if the worst scenario happens, you're still in pretty good shape. The cash flow is good enough, you're not going to be in trouble. So you can move forward with something like this and be confident. Instead of rejecting ARMs altogether without even looking at it, you have to run the numbers and see what your exposure really is. Are you putting yourself at risk? Now, if you did put yourself at risk, let's say in year 6, it was cash flow was minus 200 a month, and year 7 it was minus 400 a month, and year 8 it was minus 500 a month, and so on. Well, then you're taking on unnecessary risk. The odds that everything's going to go wrong between now and then is kind of small, but you always have to plan for the worst case scenario. So that's what you plug into your spreadsheet. And and when you get the numbers from Chaley or anyone else, whatever lender you're working with, sometimes they just give you the percents. I wouldn't just go by the percents, because then you have to figure out what the monthly payments are, and you might do it wrong and put the wrong numbers. I always ask for the actual dollar amount. What is the dollar amount year 1 through 5? What is the dollar amount in subsequent years? So I know that I'm taking out my personal error out of the equation and having some firm numbers to work with. So this property also, by the way, with 5% appreciation every year, offers $83,000 a month, $83,000 total equity growth over 5 years. So when you have minimal risk like this, even if the worst case happens and you have a chance to make 83K in equity growth, and you have all this cash flow in the meantime, this looks like a solid investment. All right, so that I promised that was the most detailed scenario we have. We'll wrap up with an easy one. Should I raise rents as much as possible? This is a question that comes up a lot. So here's a scenario. An Atlanta property is getting $1,400 a month in rent, and the lease is due to be renewed. The market is hot, so the property manager looks at the rental comps and says that you should raise the rent to $1,600 based on rental comps. And that's a $200 a month jump, which is a huge jump for the tenant. So here's the conundrum that the investor's in. The investor could raise rents to $1,600 to the max and then risk having the tenant leave, or he could just do a moderate rent increase of $100, but then that kills him because he's leaving money on the table. So how would you evaluate the scenario? Well, let's consider what happens if the tenant leaves. So what's the cost of a vacancy? So the tenant's currently paying $1,400 a month. If the tenant leaves, you're going to have at least 1 month of vacancy. It's going to take that long to clean the place up and advertise and find a new tenant to replace. So you're out $1,400 for that month of vacancy. Then, even if your property manager finds a new tenant at the $1,600 level, they typically charge a 1 month's tenant placement fee. So the first month of rent goes to the property manager because they had to do all the tenant screening, they had to do the background checks, the interviews. So they charge you a month's rent for that. So now you're out $1,600 for that first month. And then of course, you have paint, you have cleaning, anytime you have a turnover, you have some make ready to do, and that's a pretty modest make ready for 2,000. They go a lot higher, 3, 4, 5,000. But in this scenario, let's say he just has 2,000 in make ready. So it adds up to $5,000 out of pocket that this investor lost. Why? Because he got greedy. Instead of settling for $1,500 a month, he swung for the fences and went for $1,600 and is out $5,000. So the difference between 16 and 15 is $100 extra. So was it really worth it to get that extra $100? So you take the $5,000 that he lost and the $100 that he gains. It's going to take him 50 months, 50 months, to recover his loss from this vacancy. That's over 4 years. So I mean, investors know that vacancy is not a good thing, but when you quantify it and see how much money it's really costing you, it's really sobering to see what a vacancy really cost you. So here are some considerations, things to think about. Number one, property managers' default setting is to try to get maximum rents for their investors. That's just the way they are. I had a property manager just raise rent on somebody for $25 a month, didn't even ask me. The lease was up for renewal, so she just reflexively raised the rent $25 a month, and the tenant pushed back, and I could have possibly lost a tenant. So you have to really manage your property manager. A couple months before the lease expires, have that conversation about what the rent should be. Secondly, property managers don't mind turnover as much as investors do, because the $100 a month in property management fees that they get for managing your property, that doesn't really give them a lot of money. But when there's a turnover, then they get the 1 month's rent for the tenant placement fee. They send the work crews out to clean the carpets or fix things. So I won't say that they intentionally welcome vacancy, but they don't mind it, whereas we as investors do mind it. The next one's a bit of an editorial. In my experience, the best tenants have options. If you have a tenant who's really good, who's got a great work history, good payment history, good credit score, takes care of the property, that tenant can go anywhere. You can rent a place in any apartment building in town. You can rent another house, might even be able to buy his own house because he's such a good situation and a good tenant. If you try to squeeze every last dollar of rent out of this tenant, they might leave because they do have options. And you might find yourself over time having tenants that don't have options. So is it really worth trying to squeeze every last dollar out of this tenant? I would say most cases, probably not. So what I would do in this situation, I would have the property manager talk to the tenant and show him the comps, saying that this house in this neighborhood is going for $1,600 a month, but because you've been such a great tenant, we're only going to raise it $1,500 a month. So this tells the tenant two things. One, the rent increase is fair, but secondly, if the tenant is thinking about moving because the rent increased, he knows that he's not going to be able to find anything at the same price. He's going to probably have to pay $1,600 for the same thing. So that's these are all considerations to keep in mind. If the tenant knows that, then the increase is fair, they're more likely to stay. So I said up here that in most cases it's not worth the risk of alienating the tenant. When might it be worth the risk? One thing is to track your expenses. If you track your expenses over time, if you find your expenses are growing faster than your rents, then you might need to be more aggressive with rent increases. So let's say you have an 80-year-old house. We see this a lot with older homes. An 80-year-old house in Detroit, and your rents are going up 3% a month, but your expenses, maintenance and stuff, is going up 5% a month. Well, over time, as that goes, your cash flow is going to get squeezed. In fact, in that scenario, you might consider selling the house to a owner occupant who's going to live there. But if you're keeping it as a rental and you see that your expenses are growing faster than the rents, then you might want to be more aggressive about your rent increases. The other scenario is a property that, let's say you just bought a property and it has a tenant in place. The tenant's been there for 10 years and they're paying way below market. They're paying maybe $400 or $500 below what the market rate is for such a property. Well, and in that case, you know, you might have to be aggressive, work with them, but consistently raise the rent to try to get it close to market. So as I said, in most cases, it's not worth the risk. My personal feeling is that it's better to keep the tenant. The money you lose from having a vacancy far outweighs the money you'll lose by having your rent slightly under market. When you raise the rents from 1,400 to 1,500, the way I look at it, you're being an investor. You're looking at market conditions and making a prudent business decision to raise rents moderately. But if you go from 1,400 to 1,600 and try to max out the rents, now you're not an investor. Now you're a speculator. You know, you're really swinging for the fences and trying to get the max rent out of there. And you know, the risk reward ratio just goes off the scale. I would rather have 1,500 a month and no vacancy, and not have to worry about replacing the tenant. But that's me. Your mileage may vary, as always. Okay, so let's recap. So today we went through some very common decisions that we hear investors make and struggle with. In some cases, running the numbers means comparing your different options. What happens if I pay off this loan versus buy another property? Or what happens if I use a HELOC versus not using a HELOC? And then in other scenarios, just require taking the existing pro forma and then making some edits to reflect what's changed since the time you saw that pro forma. Maybe the property price changed, maybe interest rates have gone up, maybe the rents are higher. So you just take the existing pro forma and just make some back of the envelope changes. So I think you can see, or hope you can see, that this isn't necessarily rocket science. Some people, they think, oh, running numbers, they freak out. It's not. It's nothing to it. You run the numbers, and it's a core competency as an investor. You really need to be able to do the math and independently arrive at your own conclusions. So I think what was clear. Oops. Let me go back. There isn't necessarily one right answer for each scenario. The numbers can tell you one thing. That's one piece of the puzzle, one data point, but there's other things to consider as well. Non-financial factors like your mindset, your outlook for the economy, whether we're going into recession or not, your risk tolerance, that sort of thing. So factor all of that stuff together, including the numbers, and use your own judgment. And as always, feel free to ask your investment counselor for feedback. So if you have a problem or a decision that you're struggling with, go ahead and take a first pass, run some numbers, do the math, and then run it by your investment counselor. Say, here's what I'm trying to decide. Here's how it looks to me. Am I missing anything? And the investment counselor will be happy to look at it and give you feedback. What we don't like is when an investor says, I have this problem, think for me and tell me what to do. We don't want to be in the business of telling you what to do. We want you to be empowered to be able to do your own numbers and understand why you're doing what you're doing and why it's the best decision for you. Okay, so what's next? If you have a math problem that you're stuck with or something that you're considering, reach out to your investment counselor. We're here to help as always, and there's some resources on our website, webinars, realwealth.com and realty.realwealth.com with more education. If we get a lot of the same math questions in response to this, and enough of them, then we might be able to do another webinar like Real Estate Math Part 2 and go over some more scenarios that are very common and that a lot of people are dealing with. So with that, I'll open it up to questions. I'm a little hesitant to open it up to questions because this subject matter with numbers, it's hard to explain sometimes a quantitative answer without having a whiteboard to do the math or a spreadsheet. So I don't know if I can answer any questions. Maybe if they're conceptual questions, I can answer them. But if it's something that requires number crunching in real time, then I might have to defer to your investment counselor. So let's see if I can read any questions here. Where's the question box? Oh, here it is. Whoa, we got a few. All these projections seem theoretical. There's no mention of maintenance increase, which could eat into the return. Yes, of course. I wanted to keep the spreadsheet simple. Most of the scenarios here were brand new construction homes, and there's really no maintenance, because on a brand new construction home, everything's still under builder warranty. But yes, if you bought a property, you would certainly have a line item for maintenance. In our pro formas, we typically don't have a line item for maintenance or a line item for vacancy. We recommend that you add those in on your own, because they vary. Let's see if I can read this. No allowance for repairs and vacancy. Yeah, same question. Tom Benton, do you factor in appreciation for your ROI calculations? Typically, no. I have a little footnote that says here's what the potential appreciation is, but if you calculate that in your ROI, then you're kind of banking on the appreciation. We like to look at the cash flow on itself. Does the investment stand on its own? And think of appreciation as icing on the cake. But if you wanted to, there's nothing wrong with that. It's certainly a valid approach. You look at everything. You have cash flow. You also have appreciation. You also have principal pay down over time. You have tax benefits. So there's a lot of different ways that real estate pays you. You can make a really complicated spreadsheet to incorporate all that. But for today's purposes, I just kept it simple. Sam would like to know, do you know of any bank that does HELOCs on investment properties? Good question. Generally, no. Basically, the bank likes giving loans on your primary residence because it's a very safe loan for them. When people run into financial difficulty, they'll lose their their car, they'll lose their cable, they'll stop eating out in restaurants, but they won't lose their home. That's the last thing they give up. So the default rate on HELOCs is very, very low. So the banks like that because it's a very safe loan for them. And as far as an investment property goes, which you're not living in, and maybe the investment property is performing, maybe it isn't, that's a much riskier loan for them. So they tend not to do it. Chaley Ridge, our boutique lender I mentioned earlier, she does offer HELOCs on investment properties. She's on our website, but only if it's a first lien position. So if there's no other mortgages and no other liens or encumbrances on the property, in other words, if you own the property free and clear, it's investment property you own free and clear, then she can give you a HELOC on that. So I would contact Chaley. She's the only person I know of that offers HELOCs on investment properties, certainly the only one on our site. If anyone watching knows of a lender that does loans on or HELOCs on investment properties, just write that in the comments. We'll check them out, and if they check out, we can add them to our website. But even if you don't get the loan on the HELOC on the investment property, there are other ways of unlocking your equity. You can do a cash out refi, for example. Tina would like to know, can you write off the interest on HELOCs? Yes, you can. It's a business expense just like any other. So the interest is tax deductible. Let's see if I can read this. Can't get this arrow to move up. Oh, maybe that's it. At this stage, for peace of mind, I would pay it off. Okay, so Winston has a different take. For peace of mind, he would pay off the outstanding loan. That's perfectly a valid comment. Something that she could do. If it helps her sleep at night, then that's okay. But I would rather have 100K or 50K sitting in the bank, because what gets people into trouble is liquidity. In 2008, it wasn't that their asset price collapsed. It was that they ran out of money and they couldn't keep making the payments during the hard times. So I would personally keep more in a money market fund, at least 50K, just to be a financial cushion. That offers more safety and security and peace of mind than paying off a loan that's 4% interest, in my opinion. But you could have a different opinion. Do most investors use cost segregation to front load the depreciation in the first year? Mark wants to know. No, not usually. It's done a lot for apartment buildings because you have a huge building and a large amount. But if you have a high price property, a $400,000 property in North Carolina or Florida or something, it might make financial sense to do cost segregation. What cost segregation is, for those that don't know, it's a way, instead of depreciating the property across the board over 27 and a half years, you say the appliances are going to last 7 years, so you depreciate that over 7 years, and the roof is going to have to be replaced every 20 years, so you depreciate that on a 20-year schedule instead of 27, and so forth. So what happens is you have to get an engineer to go through the house and make a line item about what you have in there and at what rate it'll appreciate. And it costs money to have that segregation study done, but if it's a high enough price property, it might make sense to do that. And if it's a new property, you could ask the home builder, has he already done the research? And you can just leverage that. Give it to your CPA. Let's see, Mark wants to know, no, Larry wants to know, have you ever heard of a first position HELOC, less closing costs? No, well, except for the one I just mentioned. If you have a property that's free and clear and you get a HELOC from Chaley Ridge, that HELOC would be in first position by definition, because that's the only way she'll do it. But I don't know about any other. Oh, here we go. Emily says Golden West Credit Union in Utah does HELOCs on investment properties, but not just in Utah. And she has one. All right, I'm going to write that down, because once I log off here, I'm going to lose all these notes. Golden West Credit Union in Utah. So thank you, Emily, for that suggestion. Sam says, thank you. Any other notes? Well, here's someone wrote a book. Okay. James. Oh, here's more. PenFed and Bank of the West offer rental HELOCs, but there are a lot of restrictions. Okay. PenFed, Bank of the West. I know them. All right. Aristotle, my colleague, is the one who evaluates new vendors, so he'll take a look at those and see if we can get some more options for our investors. Can you post the lending person's contact info again? Okay, it's her name was Chaley Ridge. Ridge Lend. They're on our website. If you look under lenders, under conventional lenders or unconventional lenders rather, you can see Ridge Lending. Let's see what else. Any other questions here? Steve wants to know, what's a good online mortgage calculator? There are a lot of them. You can just Google online mortgage calculator. I use the one on Zillow. Actually, I'm kind of old school. I use my Hewlett Packard 12C, but Zillow has a mortgage calculator that's really good and intuitive. If you mean for adjustable rate mortgages, that I don't know. Those I've seen some online, and when I tried to use them, they were kind of confusing. And then when I got the answer, I wasn't sure I trusted it. So if you're asking about an ARM, I would just talk to Chaley. Amy wants to know why no increases in taxes insurance over 10 years? Because I wanted to keep the example simple. Both will go up, of course, in the real world. That's a contrived example just to illustrate the point. The key numbers were the rent going up and the mortgage payment going up. Those are the ones I wanted everyone to focus on. Let's see. Oh, here's one, fncalculator.com, Sam recommends. Okay, I think that's about it for questions. So thank you very much for attending. This webinar is going to be posted on our website by end of day tomorrow. It's on our website. If you look under Learn and then webinars, it should be posted by then. And you can refer to it whenever you need to. It could be a year from now. If a year from now you're making one of these decisions and you want to refresh your memory about how to think about it, you can just come back to this. So that's today's webinar on crunching the numbers. I hope everyone found it worthwhile. Thanks for watching and enjoy the rest of your day.